In 1761, a barge loaded with coal glided into Manchester along a channel that had not existed the year before. The Duke of Bridgewater had paid James Brindley to cut an artificial waterway from the Worsley coal mines directly into the city. And on opening day, crowds gathered along the banks to watch something they had no framework to understand. Coal that had cost 7 shillings per hundredweight arrived at 3 shillings and sixpence. The price had been cut in half, overnight. That moment planted an idea that would take 30 years to detonate into a national obsession. The Bridgewater Canal was not just an engineering achievement, it was proof that still water could print money. For the merchants and manufacturers watching those barges, the arithmetic was simple and intoxicating. Build a canal, charge tolls, collect dividends forever. The asset required no restocking, no harvest, no seasonal luck. Water flowed, boats passed, money accumulated. Early investors saw returns that dwarfed anything available elsewhere in the British economy. That genuine profitability is what made the mania both understandable and catastrophic. Real canals did generate real wealth. But by the early 1790s, the frenzy of speculation had raced so far ahead of any rational valuation that hundreds of schemes were being funded on nothing more than rumor and social pressure. Fortunes were staked on waterways that would never carry a single barge. By 1793, the crash had arrived, and it ruined people across England. Before canals, moving heavy goods across Britain was a slow and expensive ordeal. Packhorse trains plodded at 2 to 3 miles per hour along roads that turned to axle-deep mud every winter. Wagons carrying coal, pottery clay, or grain could cost more to operate than the cargo was worth by the time they reached their destination. The freight system was a bottleneck strangling the economy from within. That was the world the Bridgewater Canal entered in 1761. The Bridgewater Canal, engineered by James Brindley for the Duke of Bridgewater, was the displacement event that reframed how Britain thought about moving goods. Opened in 1761 and extended to Runcorn by 1776, the canal cut the price of coal in Manchester from 7 shillings per hundredweight to 3 shillings and sixpence almost immediately. Contemporaries described the reduction as miraculous, and they were not exaggerating by much. The canal did not just lower one price in one city, it demonstrated that artificial waterways could solve a problem that roads never could, moving bulk goods cheaply over long distances. Understanding why canals attracted so much investment requires understanding exactly how they made money. Canal companies issued shares, typically in denominations of £100, Investors did not pay the full amount up front. Instead, they paid in installments called calls, releasing funds as construction progressed. Once the canal opened, the company collected tolls from every boat passing through. The asset was, in essence, a toll road on water. Each additional user cost the company almost nothing, so profits scaled with traffic. For investors accustomed to agriculture or trade, where costs rose with revenue, the canal model looked like something close to a perpetual income machine. The Duke of Bridgewater reportedly netted £80,000 per year from his canal by the 1790s. The canal's capital value was estimated at over £2 million, making it one of the most profitable private infrastructure assets Britain had ever seen. That figure circulated widely in investment circles. It was the number people quoted in coffee houses and county newspapers. It was the benchmark against which every subsequent canal proposal was measured. If the Bridgewater was the spark, the Trent and Mersey Canal was the fire that spread it nationally. Authorized in 1766 and completed in 1777, the Trent and Mersey was championed by the potter Josiah Wedgwood and engineered by James Brindley. Wedgwood had a specific and pressing problem: getting fragile pottery from his Staffordshire factories to the Liverpool docks without it arriving as rubble. By road, the journey cost £2.10 per ton. By canal, the same journey cost under 15 shillings. The saving was not marginal. It was transformative for his entire business model. But the investment story was even more striking than the freight story. Trent and Mersey shares had been issued at £200. By the late 1780s, they were trading at over £2,000 on the secondary market, a tenfold return in roughly a decade. That single figure appeared in nearly every canal prospectus written during the Mania years. It became the proof that canal investment worked. Those returns did not exist in a vacuum. The broader economy of the 1780s created the conditions that made them explosive. Britain in the 1780s was recovering from the American War and accelerating into industrialization. Factories were expanding across the Midlands and the North. Manufacturing output was rising, and with it, a growing class of merchants, manufacturers, and professionals had surplus capital they needed to put somewhere. The options were limited. Government consols, the standard safe investment, yielded only 3 to 4%. Land was expensive, illiquid, and socially restricted. Canal shares offered something rare: accessible, high yield, and backed by visible physical infrastructure. For a middle-class investor in 1788, canals were almost the only game in town. The wave of new canal completions between 1788 and 1789 reinforced that impression. The Oxford Canal reached Coventry, the Thames and Severn opened. Each new dividend announcement rippled outward through the press. Regional infrastructure stories became national investment narratives. The displacement phase of Canal Mania was not irrational. Early canals genuinely slashed freight costs, generated extraordinary returns, and filled a real gap in the investment landscape. The Bridgewater and Trent and Mersey were not illusions. They were working machines that paid their shareholders handsomely. The problem was not that canals were bad investments. The problem was that the evidence of their success made it almost impossible to ask whether the next canal, and the one after that, and the 50 after that, would perform the same way. By 1789, the question in British commercial circles was no longer whether canals made money. That had been settled. The new question was which canal to back, and how quickly a subscriber could get their name into a book before the allotment closed. What followed over the next 4 years was one of the most concentrated bursts of infrastructure investment in British history, driven partly by genuine economic logic and partly by the oldest force in financial markets: the fear of being left behind. Between 1789 and 1792, Parliament authorized approximately 51 new canal acts, more than in the entire previous 3 decades combined. The peak came in 1793, when over 20 canal bills were presented in a single parliamentary session. The pace was staggering. Legislators who had spent careers reviewing 1 or 2 canal proposals per year were suddenly processing them in batches. Each bill required surveys, petitions, and hearings, and the parliamentary machine was straining under the volume. To understand how that volume was generated, it helps to understand how canal investment actually worked at the street level. A promoter would begin by publishing a prospectus, a document outlining the proposed route, the projected traffic, and the anticipated returns. The prospectus would be distributed through local newspapers and posted at coaching inns. Then a subscription book would open, usually at an inn or a local bank, and investors would write their names down for a set number of shares. The initial commitment was small. A deposit of £1 or £2 secured an allotment in a share nominally valued at £100. The rest would be paid in calls over the following months and years as construction demanded funds. This structure meant that an investor could accumulate a substantial paper position in multiple canal schemes with very little actual cash outlay. Paper fortunes were easy to build. The calls, when they came, were another matter. The engineers who designed canals became celebrities, and their names on a prospectus functioned as endorsements that could fill a subscription book within days. James Brindley had died in 1772, but his reputation was already legend. His successors, William Jessup, Thomas Telford, and John Rennie, inherited that credibility. Investors who knew nothing about gradient surveys or lock mechanics understood that a Jessup-surveyed canal was more likely to be viable than one backed by an unknown. Promoters competed to attach prominent engineering names to their schemes, sometimes paying survey fees simply for the marketing value of the association. The Grand Junction Canal, authorized in 1793, illustrated the boom at its most intense. The canal was designed to connect London to the Midlands via a more direct route than the existing Oxford Canal, cutting journey times and costs for the most commercially active corridor in England. Its subscription was reportedly oversubscribed within days. Shares changed hands at a premium before a single yard of earth had been turned. The project was real, the engineering was sound, and the economic case was solid. But the speed of the subscription reflected something beyond rational assessment. It reflected panic buying. The boom was not confined to a single region. It spread geographically with remarkable speed. In the West Midlands, the Birmingham Canal navigations, already profitable and well-established, spawned a cluster of branch canal proposals, each promising to extend the network into adjacent territory. In Yorkshire, the Rochdale Canal, the Huddersfield Narrow Canal, and the Leeds and Liverpool Canal all sought additional capital in the same years. In the West Country, multiple schemes competed to link Bristol to the Thames. The map of proposed canals in 1791 looked less like a planned network and more like a web drawn by competing ambitions. Alongside genuine investors, a secondary market in canal shares emerged that had nothing to do with financing construction. London coffeehouses, particularly Jonathan's on Change Alley, which would later become the Stock Exchange, and provincial inns across the Midlands and North, became informal trading floors. Shares were bought and sold at rising premiums by people who had no intention of holding them through to a canal's completion. The goal was to buy cheap and sell dear, usually within weeks. Pure speculation existed alongside genuine investment, and the two were often indistinguishable from the outside. Birmingham Gazette and the Leeds Intelligencer both ran near-weekly reports on new canal proposals through 1791 and 1792. The language mixed civic pride with barely concealed investment advice. One typical notice described a proposed canal as essential to the prosperity of our manufactures, then immediately noted the terms of the subscription and the location of the booking inn. Newspapers were not just reporting the boom, they were amplifying it. The involvement of Britain's most respected commercial names gave the boom an air of legitimacy that drew in more cautious investors. Josiah Wedgwood, whose Trent and Mersey investment had already made him wealthy, subscribed to additional canal schemes in these years. Matthew Bolton of the Soho Manufactory in Birmingham, one of the most admired industrialists in Britain, also participated in multiple subscriptions. When names like these appeared on a prospectus, the implicit message was clear: if men of this caliber are investing, the risk must be acceptable. The boom phase had a coherent internal logic. Low deposit requirements made entry easy, rising share prices made inaction look costly, respected names made participation feel safe, and a press hungry for commercial news kept the cycle visible and self-reinforcing. The conditions for Euphoria were assembling themselves quietly, one subscription book at a time. There is a recognizable moment in any speculative bubble when the composition of investors changes. Early participants are merchants, manufacturers, and financiers who have done their calculations and believe the asset is undervalued. Later participants are people who have watched prices rise and concluded that prices will continue to rise. By 1792, Canal investment had passed through that threshold. The subscription books at coaching inns across England were filling with names that would have surprised even the most optimistic promoter a decade earlier. The economist Charles Kindleberger described Euphoria as the phase when rising prices alone become sufficient reason to buy, drawing in people with no prior knowledge of the asset. That description fits the canal market of 1792 with uncomfortable precision. The diarist and agricultural writer Arthur Young noted in 1793 that the rage for canal shares has seized persons of every description. Parliamentary testimony gathered after the crash identified investors, including clergymen, widows, schoolmasters, and small tradesmen. These were not people with experience in infrastructure finance or engineering assessment. They were people who had watched their neighbors grow richer and decided they could not afford to stay on the sidelines. The share price data from this period tells the story more starkly than any contemporary account. Trent and Mersey shares, originally issued at £200, reportedly reached £2,200 by 1792. A share in the Oxford Canal, with a nominal value of £100, was changing hands above £500. These were real, operating canals with real revenues, so some premium over face value was defensible. But a tenfold or fivefold premium required projecting decades of uninterrupted growth to justify arithmetically. More telling were the prices being paid for shares in canals that had not yet received parliamentary authorization. Investors were buying options on the right to invest in waterways that might never be built, at premiums that assumed they would be built and would perform like the Trent and Mersey. The price had become entirely detached from any underlying calculation. Speculators known as stags subscribed to new canal issues purely to sell their allotment at a premium the moment trading opened. The practice was well documented in the 1793 parliamentary debates on canal bills. Members complained that subscription books were filled with names of people who had no intention of financing construction and no interest in the canal's eventual success. Their only interest was the gap between the subscription price and the market price on the first day of trading. Stags were not unique to canals, but their presence in large numbers was a reliable indicator that a market had moved from investment into pure speculation. The most visible symptom of detachment from reality was the proliferation of canal schemes that made no geographic or economic sense. In late 1792, at least 4 separate canal companies were proposing to serve overlapping catchment areas around Birmingham. Collectively, these schemes required more capital than the entire existing Birmingham canal network had cost to build. They also projected more traffic than the regional economy could plausibly generate, even under optimistic assumptions about industrial growth. Yet all 4 attracted subscriptions. The promoters were not necessarily dishonest. Some genuinely believed their route was superior to the competitors, But the market's willingness to fund all four simultaneously suggested that subscribers were not comparing proposals. They were simply buying. The engineer William Jessup, one of the most respected figures in the profession, wrote privately in 1792 that projected traffic figures in several schemes he had been asked to survey were entirely imaginary. Jessup's concerns were not publicized. They circulated among a small number of professional engineers and had no effect on subscription demand. This was a characteristic feature of the Euphoria phase. The people with the most relevant knowledge were the least able to influence the market. Investors were not consulting engineers to evaluate Canals. They were consulting share prices to evaluate the wisdom of buying. A correspondent to the Gentleman's Magazine in early 1793 captured the social pressure with particular clarity. No man of business, the writer observed, could afford to stand aside while his neighbors grew rich. The phrase reveals something important about how Euphoria sustains itself. At a certain point, the decision not to invest requires active justification. Caution becomes socially costly. The burden of proof shifts from those buying to those abstaining. Rational skepticism was not absent from this period. It was simply powerless against the social and financial momentum that had built up. When prices rise consistently for several years, every previous skeptic has been proven wrong, and every previous buyer has been proven right. The track record of the market overrides the analysis of the individual. Even experienced investors who recognized the excess found it difficult to act on that recognition, because acting meant selling into a rising market and watching others continue to profit. The psychology of the Euphoria phase does not require stupidity. It requires only that individual rationality be overwhelmed by collective momentum. By early 1793, canal investment had transformed from a specialized commercial activity into a broad social phenomenon. Prices had lost their connection to engineering reality. Schemes multiplied beyond any rational assessment of demand, and the voices of caution, where they existed, went unheard. The market had entered the final, unstable phase that precedes every crash, the phase where the only argument for buying is that everyone else is buying too. Bubbles do not deflate gradually. They require a trigger, something that shifts the dominant mood from confidence to doubt fast enough that sellers outnumber buyers before prices can adjust. In early 1793, two triggers arrived in rapid succession, and neither had anything to do with the engineering merits of British canals. What followed was a collapse that erased paper fortunes, froze credit across the Midlands and North, and left hundreds of canal schemes stranded between authorization and completion. The execution of Louis XVI in January 1793, and Britain's declaration of war against revolutionary France in February 1793 created an immediate financial shock. War financing required the government to borrow heavily and quickly. That demand drove up interest rates across the board. Government consols, which had been yielding 3 to 4% and looked dull beside canal premiums, suddenly became more attractive as rates rose. At the same time, the outbreak of war destroyed confidence in discretionary investment. Canal shares were not essential assets. They were speculative positions, and in a crisis, speculative positions are the first things sold. The war and the credit shock were external triggers, but the canal market had its own internal mechanism that turned a correction into a rout. The call system, which had made entry into canal investment so easy, became lethal on the way down. As canal companies began demanding installment payments to fund actual construction, investors who had accumulated large paper positions on small deposits suddenly faced cash demands they could not meet. The only way to raise cash quickly was to sell shares, but selling into a falling market depressed prices further. Lower prices triggered more margin pressure on other investors, who then sold too. The feedback loop was self-reinforcing and accelerating. Trent and Mersey shares fell from approximately £2,200 to under £1,000 within months of 1793. Oxford Canal shares dropped by more than half. Shares in canals that were unbuilt or only partially constructed became essentially worthless because no buyers could be found at any price. The secondary market that had been so active through 1791 and 1792 simply ceased to function. Jonathan's Coffee House, where canal shares had changed hands at rising premiums, went quiet. Provincial inns that had hosted subscription signings were now hosting creditors' meetings. The share crash did not stay contained within the canal market. It spread into the banking system. Country banks across the Midlands and North had lent money against canal shares as collateral. When share prices collapsed, the collateral evaporated. Banks that had extended credit on the assumption that a portfolio of canal shares was sound security suddenly found themselves holding paper worth a fraction of the loans it backed. Approximately 25 country banks failed in 1793, according to contemporary banking histories. The credit contraction that followed hit manufacturers and merchants who had no direct involvement in canal speculation at all. A mania that had begun in infrastructure finance ended by disrupting the broader economy. Birmingham merchant and canal promoter Samuel Garbett wrote to a correspondent in mid-1793 describing universal distress among his acquaintances. Several prominent subscribers could not meet their calls and faced legal action from the canal companies themselves. The archives of the Coventry Canal Company contain letters from shareholders begging for extensions on payment deadlines, some offering personal property as security, others simply pleading inability to pay. These were not reckless speculators by the standards of the time. Many were established businessmen who had treated canal shares as a reasonable commercial investment and found themselves legally obligated to pay installments on assets that were now worth less than those installments. The government passed the Canal Loans Act of 1793, authorizing the Exchequer Bill Loan Commissioners to lend up to £500,000 to struggling canal companies at low interest. It was an early example of public support for private infrastructure investment, and it reflected the government's recognition that canals, whatever the speculative excess surrounding them, served a genuine public function. The loans helped some companies survive long enough to complete their works. They were insufficient to rescue the most speculative ventures, and they could not restore the private capital that had been lost. But they prevented the immediate collapse of several partially built canals that would have been economically valuable once completed. Beyond the financial mechanics, the crash left a psychological mark that is worth recording in its own terms. Arthur Young, who had noted the universality of canal fever at the boom's height, wrote in late 1793 that the madness has given way to a despondency equally unreasonable. His observation was precise. Panic selling had pushed even genuinely sound canal investments below their rational value. Investors who had overpaid at the peak were now selling at prices that understated the long-term earning power of operating canals. The crash overshot rational value on the downside, just as the boom had overshot it on the upside. Both extremes were driven by the same force, collective emotion overriding individual calculation. The crash of 1793 was fast, severe, and contagious. External shocks provided the trigger, but the internal mechanics of the call system and the leveraged secondary market ensured that once selling began, it could not easily stop. Fortunes accumulated over years of rising prices were destroyed in months. The canal network that remained was a fraction of what had been authorized, and the financial system that had funded the boom would take years to recover. Financial crashes are usually remembered for what they destroyed. Canal mania destroyed a great deal: fortunes, credit networks, merchant families, and the savings of clergymen and widows who had trusted a rising market. But the physical record of the mania is more complicated. The waterways that were actually completed did not disappear with the share prices. Many of them worked. And the economic consequences of that working infrastructure extended far beyond anything the original investors had calculated. By 1810, England had approximately 3,000 miles of navigable canals, much of it built during or immediately after the Mania years. That network formed the arterial system of the early industrial revolution. Coal moved from pithead to factory, raw cotton moved from port to mill, finished pottery, iron goods, and textiles moved to market at costs that would have been impossible by road. The canals did not merely serve the industrial revolution. In a meaningful sense, they enabled its pace and geographic reach. Not every canal authorized in the Mania years was completed, and not every completed canal was equally useful, but several were transformative in exactly the way their promoters had promised. The Grand Junction Canal, completed in 1805, connected London to the Midlands via a more direct route than any previous waterway, cutting freight costs along the most commercially active corridor in England. The Rochdale Canal, completed in 1804, crossed the Pennines and linked Manchester to the Yorkshire wool towns, opening a route that had been commercially impractical before. The Kennet and Avon Canal, completed in 1810, connected Bristol to London via the Thames, giving the West Country a viable bulk freight route for the first time. Each of these canals fulfilled its economic promise, validating the original displacement thesis even as the speculative frenzy that funded them was universally condemned. The human cost of the crash was real and lasting, and it deserves to be set alongside the infrastructure achievements. Parliamentary poor relief records and county court filings from 1793 through 1796 show a spike in insolvency proceedings concentrated in canal-heavy regions. The Staffordshire and Worcestershire area saw several prominent merchant families permanently ruined. The broader credit contraction that followed the bank failures of 1793 depressed wages and employment in manufacturing districts through the mid-1790s. Workers in industries that depended on commercial credit felt the consequences of a speculative episode they had never participated in. The Canal Mania directly shaped how Parliament and investors approached the railway mania of the 1840s, because the pattern was recognized even as it was being repeated. The experience of 1793 contributed to growing pressure for better parliamentary scrutiny of private bill promotions. The procedures for examining canal bills had been inadequate to filter out duplicative or unviable schemes, and that failure was noted explicitly in subsequent debates. When railway promotion began in earnest in the 1830s and 1840s, the language of the 1793 crash appeared in parliamentary speeches and financial commentary. Observers who remembered Canal Mania or had read about it warned that the same dynamics were reasserting themselves. They were correct, and the warning made almost no difference to the outcome. Beyond regulation, the mania left a more practical legacy in the form of institutional and human capital. Even failed canals had accomplished something. They mobilized engineering expertise on a scale Britain had never seen. They trained tens of thousands of laborers, men who became known as navigators, shortened to navvies, a term that would attach itself to construction workers for generations. They established the legal templates for large-scale joint stock infrastructure investment, the prospectus format, the parliamentary procedure, the calls system, the toll structure. When railway promoters began their work in the 1830s, they did not invent these instruments. They inherited them directly from the canal era. The railways that the canal network helped make possible would render most canals commercially obsolete by the 1850s. Canal share prices collapsed a second time as railway mania drew investment away in the 1840s. The waterways that had seemed like permanent income machines in 1792 were carrying a fraction of their former traffic by 1860. The irony was complete. The demand for bulk freight transport that canals had proven and the joint stock financial model that canal investment had established were the foundations on which the railway industry was built. The canals had funded their own obsolescence. Zooming out from the specific history, Canal Mania fits into a larger pattern that has repeated itself across 2 centuries of capitalist development. The Minsky-Kindleberger framework describes a sequence. Genuine innovation creates a displacement event. Rational early investment establishes proof of concept. Success attracts broader participation. Prices rise beyond rational valuation. Euphoria draws in uninformed buyers. A trigger causes panic, and the crash overshoots on the downside. Canal Mania followed that sequence with almost textbook precision. So did railway mania in the 1840s. So did the American stock market in the 1920s. So did dot-com equities in the late 1990s. So did housing in the 2000s. The investors who lost fortunes in 1793 were not fools. Many were the most commercially sophisticated people in Britain, but they were caught in a dynamic where individual rationality and collective irrationality pulled in opposite directions, and the collective one. Each step toward the peak made sense given what the market was doing at that moment. Each step was also, in retrospect, a step closer to ruin. The clergymen and merchants who queued to sign subscription books at coaching inns in 1792 were not making a different kind of mistake from the one investors make today. They were making the same mistake in the same way for the same reasons. The canal is different. The mechanism is not.